Why are people pulling their money out of what we always thought were the safest assets on Earth, government bonds, and, well, rushing toward alternatives like gold and Bitcoin? Welcome to the deep dive.
It really is a remarkable stack of sources we looked at. We've got economic history, some fascinating recent academic research on political psychology, and then high-level macro market analysis too.
Yeah.
And the core theme that just jumps out, connecting everything, is this erosion of trust. Trust in the political institutions, trust in the financial institutions that are supposed to provide stability. We're not just seeing a market rotation here. It feels like we're tracking a really fundamental shift in confidence.
Absolutely. And our mission today is laser-focused. We want to understand the motivations behind this exodus. Why are ideological crypto folks and, huge institutional giants now increasingly looking at assets disconnected from the state, like Bitcoin, like gold, as the real safe havens? We're exploring how this deep political skepticism has almost become, a quantifiable, tradable asset class itself. Okay, let's unpack this. Maybe start with the psychology behind it all.
Yeah, to really get the modern investor's mindset, I think you have to start not with the tech, but with crisis, specifically 2008.
Right, the global financial crisis.
Yeah, exactly. The birth of Bitcoin, the white paper that launched it, came out right at the height of that crisis. That wasn't a coincidence, not at all.
Yeah.
It was explicitly designed, the sources say, as an invention to let people exit what looked like an apparently failing financial system.
Right.
Bypass the banks, bypass the governments that had failed to regulate them properly.
That context is so vital, isn't it? It really highlights that Bitcoin wasn't just some technological novelty. It was right from the beginning a kind of politico-economic challenge, a challenge to the existing order. The fundamental promise was, look, transactions secured by math, by cryptography, needing no trusted third party, no government, no central bank.
Precisely. And this ideological stance, it leads us straight to this concept of the long-term holders, the O-dealers.
Ah, yes, HODL, hold on for dear life, originally a typo, right?
Yeah, famously started as a misspelling of hold on some forum, but it's really evolved, hasn't it? It's become a defined investment philosophy now. These investors, they aren't just chasing quick profits. They're practicing long-term holding, ho-dealing, because they genuinely hold this ideological belief, separation of money and state. They're essentially taking their faith out of the political system and putting it into mathematical code.
Okay, but is this just, a story people tell? Is it just anecdotal, maybe a fringe belief? Or does the actual data establish a hard link between the skepticism and how people invest?
Well, that's the fascinating part. The data absolutely backs it up. It makes it much more than just theory. We saw some key findings from Finnish panel data collected between 2022 and 2023.
Okay.
And this research found a direct measurable correlation. Individuals who scored higher on political distrust, and they measured it specifically, distrust towards the government, the parliament, politicians in general, these people were significantly more likely to be the long-term holders, the HO dealers of cryptocurrencies.
Wow, okay. That is profound. It means this political cynicism isn't just passive grumbling. It's being, as you said, commodified. It's actively transformed into a defensive financial position. But why does that strategy actually make economic sense for them?
Because fundamentally, they're hedging against what they see as anticipated failure. If you, as a citizen, have really low faith in political leadership, you anticipate mismanagement, right? You expect loose monetary policy, maybe systemic crises down the road that the conventional financial markets just won't handle.
Yeah.
So in that scenario, diversifying your wealth into autonomous, decentralized assets like Bitcoin, it isn't reckless. For them, it's a rational strategy. It's about preserving capital against what they see as an expected political and fiscal collapse.
This really marks a critical shift, then, in how we understand financial trust. Economic studies often focus so narrowly on profit motives, risk-reward calculations. But here, the underlying psychological driver seems to be the perceived systemic shortcomings of the whole conventional financial system. It suggests the origin of future trouble is seen as political failure first, rather than just, say, market risk.
That's the absolute key takeaway, I think. If the source of potential financial disaster is political, bad regulation, maybe too much debt, government overspending, then the antidote logically has to be an asset that's immune to political meddling. And this narrative, it's even being confirmed by mainstream finance now.
You mean like institutional players?
Exactly. I mean, when the CEO of BlackRock, Larry Fink, calls Bitcoin digital gold and explicitly frames it as a safeguard against currency devaluation and poor policies, that validates the whole strategy for the really affluent investor too. They're positioned to move significant amounts of wealth completely outside the traditional banking system if they need to.
Okay, so if political distrust is the psychological fuel, let's look at the financial fire. The macro chaos, as the sources put it, that these skeptical investors are trying to hedge against. What exactly is making traditional government debt look so unattractive right now?
Right. We're definitely seeing this convergence of macro factors. It really amounts to a kind of perfect storm favoring these decentralized assets. We can probably identify 4 key elements here.
All right.
First, currency weakness. Bitcoin, generally speaking, tends to move inversely to the DXY. That's the US dollar index, right? It measures the dollar's strength against other major currencies. So weakening dollar usually increases global demand for wealth protection outside of fiat currencies.
And we've certainly seen gold surging recently, too, which kind of reinforces Bitcoin's appeal as its, modern digital counterpart.
Exactly right. Then, the second and third factors are directly about fixed income. Traditional safe haven assets, things like long-term government bonds, they're offering really low, sometimes negligible, or even negative real yields once you account for inflation.
Yeah, you're losing money holding them in real terms.
Precisely. This yield-starved environment, it just forces money away from the instruments that traditionally generate income. And then you combine that with a fourth factor. Traditional stocks trading at historically pretty high valuations, and, well, the safe havens in the conventional system just seem to vanish.
This speaks directly to that collapse in the appeal of traditionally safe things like U.S. treasuries or German bonds. The sources highlighted a really critical underlying concept related to this, the declining convenience yield. Can you unpack that a bit?
Yes, the convenience yield is maybe the most important concept to grasp here. It's essentially the premium investors have historically been willing to forego the lower returns they'd accept, just for the privilege of holding government bonds because they're seen as super safe, super liquid, and usable as collateral.
Okay, like a fee for safety and usability.
Kind of, yeah. But analysis, for instance, from the European Central Bank, shows this yield is falling, dramatically, in fact. Investors basically value the safety and liquidity of government bonds less now, which means they demand a higher actual yield to compensate. And this reduction in demand, it puts upward pressure on what economists call the theoretical equilibrium rate of interest, or R.
Let's pause on R for a second because that's a pretty dense concept for listeners.
Yeah, it can be. Think of R as the sort of natural, friction-free interest rate the economy needs to grow steadily without causing too much inflation or deflation. When that convenience yield falls, it signals that the market is effectively rejecting the current low-rate environment. It's pushing R upward.
And why is this happening now?
It seems to be happening because we're transitioning rapidly from what economists used to call a global savings glut. That was a period of excess savings chasing scarce, safe assets, to what the sources are now terming a global bond glut.
A glut of safe assets? That sounds kind of counterintuitive. Why would there be a massive increase in bond supply?
Well, the net supply of government bonds has just increased substantially, and it seems to be accelerating. If you look at places like Germany and the U.S., the sovereign bond free float, that's the stuff actually available to trade, not held by the central bank. As a share of the total outstanding volume, it's increased by more than 10 percentage points in just the last 3 years.
Wow.
So the safety and liquidity premium of these assets falls partly just because they're suddenly so abundant. There's just so much government debt out there.
And central banks, even though they were trying to stabilize things, are now potentially making the supply issue worse by reversing their old policies.
Absolutely. You had quantitative easing, QE, which absorbed huge amounts of government debt and fiscal deficits initially. But now, as central banks pursue quantitative tightening, or QT, they're shrinking their balance sheets.
Selling bonds back to the market.
Effectively, yeah. They're dumping or letting run off trillions of dollars worth of bonds back onto the market.
Yeah.
This significantly contributes to the bond glut. And on top of that, you have these huge structural forces. Massive global spending needed for the digital transformation, the green energy transition, and suddenly this large increase in global defense spending. All of this is pushing global borrowing needs to the highest share of GDP we've seen since the 1980s.
That combination seems incredibly difficult. High borrowing demand from governments plus central banks tightening supply. It puts almost permanent upward pressure on real interest rates, doesn't it? Which makes the cost of servicing all that existing government debt just frighteningly high.
It really creates a potential vicious cycle. And then adding to this domestic fiscal pressure, you've got geopolitical fragmentation. I mean, who wants to hold massive amounts of debt from one single power, say the U.S., when that power is long-term stability or, its geopolitical relations are being questioned globally.
That's a critical point. If other countries, other central banks, stop seeing U.S. debt as the ultimate politically neutral reserve asset, where does that money go instead?
Well, the sources show a pretty marked decline in foreign official holdings of U.S. Treasury securities. It's a trend that actually started after the 2008 crisis, but seems to have deepened recently. That demand is now apparently at its lowest level in over 20 years.
20 years?
Yeah. So when the largest, most crucial stabilizing buyer foreign central banks pulls back like that, it just heightens the need for genuinely neutral, genuinely decentralized assets, whether it's physical gold or something like digital Bitcoin.
Okay, so the macro environment is clearly pushing investors away. But Section 3 in the source material tackles what feels like the core psychological anxiety driving them to alternatives. This deep-seated feel that the entire fiat currency system, money backed by government promise alone, is inherently fragile, maybe even fundamentally destined to fail.
And that anxiety, it's grounded in some pretty sobering history. When you actually review the longevity of monetary systems throughout history, the data is stark. Fiat currency systems, again, that's money unbacked by any physical commodity, deriving value solely from confidence and government decree, they're notoriously fragile. Research indicates these systems typically survive for only about 27 years on average.
27 years, that's remarkably short.
It is, and we've been operating the current global financial architecture without any commodity backing since the U.S. ended the Bretton Woods system back in 1971. That makes our modern system a completely unprecedented, decades-long experiment, really. We're way past the average lifespan.
That 27-year average is terrifying in itself, but I think the real-world impact, the thing people feel, is shown best through the loss of purchasing power over the last, 5 decades?
Oh, absolutely. Since 1971, the U.S. dollar, which is supposed to be the world's reserve currency, the bedrock, it has lost approximately 98% of its purchasing power due to cumulative inflation.
98%. Just let that sink in.
It's staggering. The dollar has already lost almost all its value over a typical working lifetime. And this, understandably, fuels the perception among long-term investors that currencies aren't just devaluing slowly. They might already be in a state of, terminal decline. They're already down 99%, metaphorically speaking, before any potential complete failure even happens.
So the fear isn't just paranoia. It's recognizing what looks like a predictable historical pattern. What are the consistent stages of monetary system failures that investors might be anticipating based on history?
Yeah, history shows a remarkably consistent 5-stage pattern across different nations and time periods when monetary systems collapse.
Okay, what are they?
Stage 1 is excessive debt accumulation. Governments basically finance their operations primarily through borrowing, creating these huge structural, unsustainable fiscal imbalances. You could argue this is where the U.S. and many developed nations are right now.
Seems plausible. Stage 2?
Stage 2 is money supply expansion. The central banks have to step in. They start creating new currency, essentially monetizing the government's debt just to maintain stability and keep the government solvent. This is the whole era of quantitative easing, QE.
Right, buying up the debt.
Exactly. Stage 3 is inflation acceleration. The sheer volume of new money eventually generates price increases that become unmanageable, sticky, and they rapidly erode people's savings. We've certainly had a taste of that recently.
You have Stage 4.
Stage 4 is confidence erosion. Both domestic and foreign investors start to recognize the unsustainability. This leads to capital flight. People start dumping the local currency, trying to trade it for foreign assets, gold, hard commodities, anything else really, which just accelerates the devaluation.
And the final stage?
Stage 5 is systemic breakdown. The currency basically becomes functionally worthless. This forces an emergency adoption of alternatives. Maybe foreign currencies dominate, maybe barter systems emerge, or a completely new system has to be built.
And looking at the U.S. right now, we seem to be seeing critical indicators of those first 2 stages accelerating quite dramatically, wouldn't you say?
Absolutely. The fiscal warning signs are, frankly, stark. U.S. federal debt held by the public is now at approximately 99% of GDP. And if you include the debt the government owes itself, like Social Security trust funds, the total debt exceeds 123% of GDP.
123%.
Yeah. And the budget deficit for fiscal year 2024 hit $1.83 trillion. That's a massive 6.4% of GDP. That's not sustainable long term.
And the cost of just servicing that debt, paying the interest, is becoming mathematically nonsensical, isn't it?
That's the terrifying feedback loop. Net interest payments on U.S. debt reached about $892 billion in FY 2024. That's already 14% of all federal revenues.
14% just on interest.
And projections show it's likely to exceed $1 trillion in FY 2025. Just servicing the debt will soon cost more than the entire U.S. defense budget. And this expense, it compounds exponentially as interest rates rise, making the total debt load look mathematically impossible to service under current or even slightly higher rate conditions. That number alone should make any prudent investor, well, pause.
And behind all of this fiscal pressure is the enormous scale of intervention the central banks, particularly the Fed, undertook to keep this arguably unsustainable machine moving after 2008 and during the pandemic.
Oh, definitely. Just look at the Fed's balance sheet as the ultimate measure of that expansion. Its assets peaked at around $8.9 trillion back in April 2022. Right now, it's still around $7.2 trillion. Now, compare that to the pre-2008 level, which was about $900 billion.
So it's nearly 8 times bigger.
Nearly 8 times the size it was before the crisis. This sheer scale of monetary expansion creates a financial system that is utterly dependent on artificially suppressed interest rates and massive amounts of liquidity. It's a dependency that simply cannot withstand interest rate levels that were historically considered normal or even necessary to control inflation.
Right. And that dependency, it almost inevitably leads to instability, doesn't it? The sheer scale of central bank intervention, I mean, even though it was intended to preserve the system, often seems to have unintentionally created fragility and, perhaps just as importantly, severely damaged public confidence. How did these aggressive monetary policies manage to undermine the very trust they were supposed to safeguard?
Well, let's start with public sentiment itself. We actually have a direct measure of this loss of faith. Public confidence in the Federal Reserve Chairman Jerome Powell, it actually peaked during the initial, very decisive pandemic response, remember, when they just flooded the zone with liquidity.
Right. Everyone felt they acted quickly.
Yeah, but that confidence has since tumbled dramatically, down to just 36%, according to polls cited in the sources, after the Fed took that hard stance on fighting post-pandemic inflation. You know, the rapid, painful rate hikes.
36%? That's incredibly low for the Fed chair.
It's a direct reflection of the economic pain that was necessary, arguably, to control the prior inflation, which itself was fueled by earlier policies. It's one of the lowest trust numbers recorded in decades for that position.
Okay, so the rate hikes were painful, perhaps necessary, but the policies that came before them, particularly quantitative easing, QE, also created some profound structural risks, didn't they? Making the whole system more vulnerable when the hikes finally came.
They absolutely did. Let's try and break down this technical concept of duration mismatch risk that QE created. When the central bank buys up long-term government debt from the market and replaces it with short-term central bank reserves held by commercial banks, it effectively shortens the duration of the consolidated government central bank balance sheet.
Okay, that is extremely technical. Can we maybe use an analogy to clarify what that shift means for, say, the public purse for taxpayers?
Let's try. Think of the government's overall debt portfolio, like a homeowner's mortgage portfolio. Before QE, you could say the government had mostly long-term fixed-rate debt, like a 30-year fixed mortgage. QE essentially allowed the government to swap a large chunk of that long-term debt for a series of short-term variable-rate loans financed by the Fed's reserves, almost like taking out a bunch of adjustable-rate mortgages or home equity lines of credit.
Ah, okay. So more sensitive to rate changes.
Exactly. When interest rates subsequently rise, as they did sharply, those short-term loans from the Fed get refinanced almost instantly at the higher market rate. This dramatically and very quickly increases the government's debt servicing costs. And it creates the potential for what's called fiscal dominance, where the central bank kind of loses its independence because its monetary policy decisions become constrained by the government's sheer inability to afford servicing its debt at higher rates.
So QE wasn't just stimulus. It was fundamentally an asset swap that made the government's entire debt structure hypersensitive to the very rate increases that eventually had to happen to fight the inflation QE. Helped fuel.
Wow. And this kind of unintended consequence wasn't just a U.S. thing, right? We saw a really stunning example of policy failure in Europe, too.
Oh, the case of the European Central Bank's bond buying program between 2015 and 2017 is, well, egregious, according to the research we saw. It found that the ECB's sheer dominance in certain bond markets, like German and Italian bonds, created these huge artificial mispricings between the actual bond prices and their respective futures contracts.
Mispricings that someone could exploit.
Precisely. This distortion allowed private financiers, hedge funds, sophisticated traders to essentially print risk-free profit through arbitrage. The estimate was up to €1.66 billion risk-free.
That's just a staggering failure of policy implementation. The research basically described this as a massive wealth transfer, didn't it? It was literally described as a direct transfer from taxpayers to arbitrageurs. I mean, think about it. The public, in theory, was being supported by the QE policy, but in reality, taxpayers were effectively subsidizing a risk-free windfall for professional bond traders. It just actively fuels that distrust we talked about in Section 1, reinforcing the idea for many that the conventional system is somehow rigged in favor of the financial elite.
And the effects of QE also created direct fragility within the commercial banking system itself, didn't they? Which eventually helped lead to crises like the Silicon Valley Bank failure last year.
Correct. As Raghuram highlighted in one of the sources, QE injected massive liquidity into banks. They held more liquid reserve assets, but simultaneously those banks issued more runnable liabilities.
Runnable liabilities, meaning?
Meaning things like large amounts of uninsured demandable deposits, deposits over the insured limit that could be pulled out instantly, and also unused corporate credit lines that could be drawn down quickly in a panic. This concentrated the liquidity exposure, especially in small and medium-sized banks that relied heavily on these types of funding. It created this latent instability.
So when rates rose sharply and businesses got nervous, the dash for cash began.
Exactly. These banks were incredibly vulnerable. The SVB collapse, where something like 97% of deposits were uninsured, was the ultimate tragic example. It just perfectly illustrated that monetary policy and financial stability are deeply, deeply intertwined, despite central banks often claiming there's a separation principle.
Right, the idea that they can manage interest rates without necessarily affecting systemic stability.
That separation principle, well, it's demonstrably flawed if you look at history. Banking crises almost always follow a pattern. First, you have easy money, where excessive risks are taken because everyone assumes low rates will last forever. Then that's followed by tight money, which acts like the pin that pricks the bubble and triggers the crisis. The central bank policy itself created the conditions for the subsequent failure.
And finally, there's also a political dimension to this central bank overreach that the sources mentioned.
Yes, the Hoover Institution source noted a really striking shift in behavior. Central bank governors, including at the Fed, seemed to actively encourage deficit spending during the crisis periods, particularly post-2008 and during COVID.
Which is the opposite of their traditional role.
Completely the opposite. It's a dramatic reversal of their traditional, almost moralizing role, where central bankers would typically lecture governments against fiscal irresponsibility. This relaxation of concern about fiscal policy, while perhaps understandable in a crisis, further signaled a potentially dangerous lack of discipline. It blurred the lines between monetary and fiscal responsibility, and arguably further eroded the public's confidence in the prudence of central authorities.
Okay, so given this whole confluence of factors, the political distrust, the inherent fragility of fiat money, the unintended consequences and perceived failures of central banking, it seems logical that investors are looking for stability outside the traditional system. Which brings us squarely to the two dominant hedges people talk about: gold, the ancient store of value, and Bitcoin, the new digital contender. Let's start with the classic choice, gold.
Right, gold. It's really the timeless safe haven, isn't it? Because it's tangible, you can hold it, it's independent of any single government or currency system, and it has proven its ability to store purchasing power over millennia. Literally.
There was a powerful anecdote in the sources about that, wasn't there?
Yes, the one about a standard 400-ounce gold bar. Apparently, back in the 1960s, that much gold could buy you a typical family home in the U.S. And today, even with home prices having obviously skyrocketed in nominal dollar terms, that same 400-ounce bar, valued at current gold prices, is still enough to buy a sizable home in many developed markets.
That really drives home the value preservation point over decades.
It absolutely does. And it's not just some historical relic. Gold performs during modern turbulence, too. The data is pretty clear. Gold has apparently outperformed the S&P 500 stock index in 7 out of the last 8 major periods of economic uncertainty or crisis. It delivered an average return of over 13.5% during those turbulent times, while the stock market often delivered negative returns.
And it's not just individuals buying it. We're seeing huge institutional endorsement, even from central banks themselves.
That's maybe the most telling sign. Central banks globally have been buying gold at a record pace since 2022. That signals their own perceived need for reserve diversification away from traditional fiat reserves, primarily the US dollar. I mean, a central bank buying gold is perhaps the most obvious vote of no confidence in other central bank currencies.
It's quite ironic, really.
It is. And the professional view among wealth managers has completely inverted. Major banks that maybe 10 or 20 years ago, recommended zero allocation to gold, now suggests a significant allocation, maybe 10% to 20% of a portfolio in some cases. This reflects a major realization. Gold used to represent only about 0.5%, 0.5% of total world financial assets. And many experts anticipate that percentage is set to grow dramatically, perhaps permanently, as institutional investors seek genuine hedging against systemic risk.
Okay, so that's gold. Now, how does Bitcoin fit into this picture? For many people, its wild volatility makes it seem like the complete opposite of gold. How can something that swings, 50% or more in a single year be considered a safe haven?
That's a really crucial question. And the answer lies in understanding what kind of safety Bitcoin offers. Its function as a safe haven isn't defined by its short-term price stability, which is admittedly low compared to gold. It's defined by its supply predictability and its decentralization.
The programmed scarcity.
Exactly. Bitcoin's programmed scarcity, that absolute unchangeable limit of 21 million units that's mathematically guaranteed by the protocol, that's the key feature. That's what makes it the modern complement, or perhaps competitor, to gold. Its supply is perfectly predictable and completely insensitive to price variations. Unlike gold, where higher prices lead to more mining, Bitcoin's issuance rate is fixed and decreases over time.
Plus, there's the effect of lost coins, right?
Right. It has this inherent deflationary mechanism built in. Lost coins, due to forgotten passwords or destroyed hard drives, are permanently removed from circulation. This only accentuates its dynamic of rarefaction, making the remaining supply even scarcer over time.
So if they are both considered hedges, but have such different characteristics, they probably correspond to different investor profiles based on their tolerance for that volatility.
That's exactly right. Gold remains the reference point for more cautious investors. It offers moderate annual volatility, typically somewhere between 13% and 18% over a 10-year horizon, based on historical data. It appeals to those whose primary goal is long-term capital preservation above everything else.
And Bitcoin.
Bitcoin, conversely, suits the more risk-tolerant investor, or perhaps the investor with a much longer time horizon. Its historical volatility has been much, much stronger, often 50% to 100% annually, sometimes even more in the early days. Though it's worth noting that trend seems to be decreasing gradually as the market matures and institutions come in through things like the spot ETFs. For Bitcoin, the safe haven status is something that's really only realized, potentially, over a 5+ year holding period, allowing time to ride out those big swings.
Okay, so therefore the consensus strategy emerging from the sources seems to be not necessarily choosing one over the other. Exactly. The consensus among many wealth preservation experts and the sources we looked at is often to hold both gold and Bitcoin as complementary assets within a diversified portfolio. The goal isn't really to predict which asset will be the single winner in the next crisis. It's more about ensuring robust wealth preservation if or when the traditional system faces its next major stress test.
So combined allocation.
Yeah, something like a combined exposure of, say, 5%, maybe 15% of a total portfolio, depending on risk tolerance. This allows investors to hedge against potential systemic failure by holding both physical and digital assets that are fundamentally outside the conventional banking and government infrastructure. #outro. So to try and summarize this really extensive deep dive, the flight we're seeing from government debt and traditional fiat currency, it doesn't seem to be based on irrational fear-mongering.
Yeah.
It looks like it's driven by quantifiable historical and structural risks that are becoming harder and harder to ignore.
We have these fiat systems that historically fail relatively quickly, that 27-year average. We have governments accumulating debt loads that look increasingly unsustainable, especially with rising interest rates. And we have central bank policies that, despite probably the best intentions, have introduced massive financial fragility and a whole host of unintended consequences, transferring wealth, creating banking instability. So the motivation to hedge seems, pretty rational when you lay it all out. It's about hedging against perceived political and monetary mismanagement.
And we saw that empirical proof, didn't we? That this isn't just some abstract economic model. It's deeply rooted in psychology and politics now. That political distrust is actively being commodified, as we said, turned into real long-term financial decisions. We saw confidence in the Federal Reserve chairman tumbled down to 36% after the rate hikes. People are directly responding by seeking security in assets that are fundamentally disconnected from political whims and central banking policies. Well, thank you for helping us unpack this fascinating and, I have to say, frankly, quite alarming set of sources today. We also want to thank our sponsor, Pipnotic, for supporting this deep dive.
The research we reviewed today really shows, quite powerfully, that political trust and economic outcomes are just inextricably linked. And if political attitudes are now actively determining core financial choices for a growing number of people, with a significant segment potentially actively positioning their wealth for the system's failure, it does make you wonder, what does this mean for the future stability of democracy itself? If the financial system is increasingly viewed not as something to rely upon, but as an entity to actively flee from.
That is definitely something for you, our listeners, to mull over or explore further on your own. Thank you for tuning in to The Deep Dive.